All right, welcome, you wonderful creative cash flowers. You asked and ye shall receive. We've had requests for getting Mr. James Jenkins on the line here to come talk to us a little bit about our insurance and our risk mitigation whenever we're talking about doing seller financed deals and what is and isn't necessary on that. So thank you so much for taking the time out of your day.
Yeah, man.
A very busy man you are. It's a very Yoda-esque thing of me to say. Very busy man you are. So to take time out to come to the studio, record, can't appreciate enough. I know everybody here is very appreciative of that. But let's jump right in, okay?
Yeah, let's go.
Get straight to the point on them. So there's several things that we need to worry about in insurance, and James is going to take the time out to explain each of these. But the quick overview of them is we need to know what ACV is versus RCV. We need to know what a covered cause of loss is. We need to know what your coverage amount needs to be. We need to know about your agent, and we need to know how the interested parties are put on the policy. So that being said, I'm going to turn this around to James. For those of you who don't know, James very successfully in the insurance agency. I don't get any kind of kickbacks from you using him. That's very illegal. We don't. But all I'm doing is putting somebody in front of you who knows his stuff, right? So James, can you kind of kick it off for us, and let's just kind of go through the list. Can you explain to me what ACV versus RCV is?
Man, this all sounds really complicated. I was thinking it would be easier to just find someone who sounds slick and sounds nice and just buy the cheapest, easiest thing that they offer me.
Yeah, that's a good idea.
I mean, it's all the same.
That's
right?
how it all works, right?
I'm not going to get this label off. I don't know why I'm even trying. So,
please don't sue me, Nestle.
There you go. This is not an endorsement. We're just drinking this unnamed water.
But how refreshing it is.
It's delicious. Glug, glug. Make sure label's out, boys and girls. Label out. There you go. Okay. So now we're totally off track. ACV versus RCV. I mean, if you remember from last time we recorded this.
I actually
there is actually a third option that's kind of halfway between the two. So ACV, actual cash value. This is the bare minimum of what you're going to get in the event of a loss. Whatever the depreciated value is based on age, kind, quality, condition of the property. That's the lowest possible number. Every policy comes standard with ACV, actual cash value, and you have to either endorse the coverage via a rider and some additional premium, or you simply select a different policy that comes standard with RCV. Depending on the age of the property, depending on the condition of the property, RCV may not be available. There is a newer development for those of you that haven't seen it before. It's actually called functional replacement value. It's kind of halfway between ACV, actual cash value, and RCV, replacement cost value. Functional replacement value is we might not make it as pretty as it once was. It might not be Carrara marble. It might instead be quartz or granite or whatever. But it's going to act the same. It's going to function the same.
Which I like that. I think that that's really a pretty common sense addition to the traditional ACV versus RCV. Yeah. Right? Like that's a great middle ground.
Yeah, and that's exactly what the carriers were looking for. They realized that people were very unhappy with ACV. The claims were being underpaid by thousands of dollars.
And let's kind of, because I don't think we necessarily dissected that enough. So let's take a look for like a roof, for instance, right? So if we've got a roof insured and we're under an ACV policy, they're going to say that that roof should last 30 years, 25 years, depending on the shingle, I guess.
30 years is standard if you got architectural shingle. If you got the basic 3-tap, it's 20 years.
Okay, so let's say 30 years, and let's say that roof got put in 10 years ago. Okay.
Which almost never happens in DFW.
Right, yeah.
I mean, if you last, 4 years on a roof, you're like, woo!
But we do have national people watching too who may not have the hail issues that we have here in DFW. But so let's say that the roof got put in 10 years ago, right?
Yeah.
Well, a third of that roof's life is done.
Yeah.
So if let's say it's a $9,000 roof and it was put in 10 years ago and I make a claim on my ACV policy, how much are they going to pay me to put a new roof on there? How much are they not pay me? How much are they going to allot for a new roof to be?
The short answer is not nearly enough.
Right. Yeah.
Because when you've got ACV, you keep in mind the deductible still applies to the claim situation, no matter what. The deductible is going to apply, which is why we don't have a lot of time to dig into it from a risk management strategy standpoint. But just as a quick aside, we always want to make sure that all of the people that I deal with, they're constantly asking themselves, how much risk am I okay with? Because when any policy you build, whether it's RCV, ACV, whether it's the value, whether it's endorsements, deductible options, cause of loss form, whatever, there's a lot of moving parts on an insurance policy. And you just need to ask yourself, what am I comfortable with from a loss position? And what do I not care about? The stuff you don't care about, forget it. The stuff you care about, then in our market in DFW, it's roof and water. And that's what matters most. To answer your question, using ACV, actual cash value, let's say we've got a hypothetical claim of $10,000. It's a real basic roof. So you've got a property value of, let's say, $150,000. 2% roof deductible, which is becoming a lot more standard, unfortunately. So you have actual cash value, you got a 2% deductible, so you got $3,000 in deductible out of your 10. Then you've got depreciation of half of the value of the claim because of the age of the roof. What half of 10,000 is 5,000. We had $3,000 in a deductible. Now for a $10,000 roof, you're getting a check for $2,000 because you had a 2% deductible for your roof and you had an ACV policy.
So let's run through that, and we don't have a whole million hours to spend on that, but let's do this. Oh, did I take my iPad thing off? Hold on. Here, coming, done. Okay, so can you draw out our numbers for us as I stick us lower into the corner for us? Just quickly run through those numbers since people may be watching visually.
So we've got a $10,000 claim. That's how much the roof is going to take. Forget the roofer. Let's just use nice round numbers. So we have a deductible. The house, and I'm terrible handwriting, sorry, house is $150K.
Don't worry, they're used to my handwriting. You're doing all right.
Let's say we have a 2% deductible. So we got a 2% deductible. That's going to be $3,000.
Because that's 2% of the house value.
2% of the house value.
Not 2% of the claim.
No,
2% of the house value.
Of the house. So $150,000 house, 1% will be $1,500, 2% $3,000, and so on. So out of our $10,000, we now have $7,000 left over after the deductible. So here's the thing. This is ACV, obviously, like we're talking about. ACV, and you said it was, the numbers I used was half, not a third. I just realized my mistake in that example. Let's say it's a 20-year roof, just your basic 3-tab, nothing special shingle, and it's halfway through its lifespan. So the whole claim would have been $10,000, but because the roof is halfway through its life and its actual cash value, it is now being depreciated by 50%. It's not 50% of anything other than the value of the claim. If the full claim is 10 grand, 50% of that is going to get slashed off of there. So we now have a $5,000 depreciation hit. Let me make sure I spell depreciation correctly.
All right. I can't help you, man. You're on your own.
$5,000 depreciation, which means grand total, your $10,000 roof just got paid for $2,000.
Because they expect you to come up with $3,000 because that's your deductible. They were only going to ever give you $5,000 for the claim because of the ACV, the actual cash value, right? They're saying it's 50% through its life. Therefore, we will only give you $5,000 of a claim on this, and I need you to come up with 3 of that. So here's your check for $2,000.
Well, and here's the thing, and it's not necessarily that the agent can wave their magic wand. And I need to put this down because I'm going to be using it to gesture.
Hey, it's all right. We can gesticulate.
It was actually on Facebook literally this morning. It hit my news feed at like 6 a.m. this morning, and I'm on Facebook early because I have nothing else to do at 6 a.m., right? This investor posted in the DFW Real Estate Investment Group on Facebook, which is, strangely enough, also nationwide. There's people in there from all over. And he posted, I need a insurance policy that will give me replacement cost value on my 26-year-old roof. It's rated for 40 years. You should be able to give me RCV. Come on, insurance people. I need RCV on a 26-year-old roof. And a bunch of people that, probably don't know much of anything. They sell insurance. They're not an insurance professional.
Yeah.
They're like, hey, so-and-so, I'd like to help.
Right.
I'm just like,
it's not going to happen.
Bro. And I posted a paragraph. I was like, I'm going to be real with you. What you're asking for is impossible.
Yeah.
And I'm going to ask you to be reasonable for a second and think like an insurance company. If a roof is rated for 40 years and it is already through 26 years, more than 50%, probably more than 60%, I'm terrible at math, more than 60% of its lifespan, why on earth do you think that the insurance company should pay for the full replacement of that roof? That is ludicrous.
It would be nice, but it's just not realistic, right?
Well, and here's the thing. The reality is most insurance companies are putting that line in the sand at 15 years.
Okay, that's good to know.
If you can't prove that the roof is less than 15 years old, then they're going to automatically require it to be ACV, and there's not a thing the broker can do about it.
And so the ACV versus RCV, can that be what's the word I'm looking at? Kind of itemized out, like we're gonna ACV on the roof, but RCV on everything else, right? Because there's even you could do because I've had it times where the house would not be insured. They would not insure the roof because it was so old, and we had to get a roof not deduction, a roof exemption. Exclusion. Yeah, there we go. Basically saying, I will insure everything except the roof. If the roof gets screwed, you're going to have to replace that. And we had to do that in order to get the insurance on there, right? So just be reasonable on that. ACV, they're going to look at, with everything, they're going to look at the age of the things that they're insuring because they are risk managers. That's what insurance is. And they're managing their own risk and then insuring your risk, right? Would that be a good way of putting that there?
Contractual risk transfer. They accept your risk and then you pay them.
There you go.
That's
a good way of putting it. I like that. Okay, so ACV is going to be what would it be worth with depreciation? I really like the what's it called, the functional replacement. That's really good. Hey, if it's solid stone, let's replace it with solid stone. Maybe it's not going to be the same exact thing. RCV is replacement cost value, right?
Yep.
What and that's pretty obvious. Yeah. What does it cost to replace this?
The same kind, the same condition. So if it's Carrara marble, you get replaced with Carrara marble.
So I'm going to tell you guys, as people who are doing owner financing, I require RCV from my buyers, but functional, I'd be just fine with functional from my buyer, right? Just don't allow ACV, because what happens is if you do ACV, we're thinking about this selfishly, but what if this is your buyer? Your buyer would then have to come up with their $3,000 deductible and the next $5,000 to get to that. So the buyer has to come out of pocket $8,000 to replace this roof. The truth of it is your buyer doesn't have $8,000 to replace that roof. And what it really functionally leads down the road to being is you may have to foreclose on somebody because they just don't have enough money to replace the roof that they have on their property, because it is their responsibility to keep that house up in good condition. That's part of the deed of trust, and that sucks. Yeah. We don't want to take people's house, first of all, but we especially don't want to take their house if it's because of a freaking natural disaster, hail, whatever, storm that's taken their roof out, and they just can't afford to replace it. Yeah. I've never taken somebody's house. I've gotten very close to having to do that, but I have paid for it and made them pay me back to keep them in the house. But that's kind of where we lead down. Okay, so in the interest of time, we want RCV, but functional cost at the very least would be good from our buyer, because we need them to be able to get things taken care of. Tell us a little bit about the covered cause of loss.
It's basically three different options. I didn't mean to be punny there, but the first of the three is basic form cause of loss. And the second is broad, and the third is special. They literally just stack on top of each other. Broad has everything basic has, and then some more. Special has everything broad and basic have, and then some more. When you Google, and I would ask you, take 30 seconds, maybe 90 seconds.
After this video.
After this video is done, or open a new tab and pause the video and come right back if you really want to, and just Google basic form cause of loss, those 5 words. And it will show you there's 8 major perils, and I can't remember all 8 of them to save my life. It's things like fire, smoke, explosion, crashing aircraft, believe it or not, is a thing. Depending on the
Johnson,
policy
we need this policy to look like it covers more. What can we cover?
Yeah.
We can't cover anything else more, Mr. Meyer. What about a crashing airplane?
Yeah, there you go.
Okay.
There are certain things, because I've read every page of every ISO Insurance Services Office standard insurance policy that every company builds their policies on top of. Every page. And I kid you not, there's probably 30 or 40 things where I'm like, what? Why is that in there? Because somebody sued somebody at some point, and some lawyer got a hold of the policy and said, next revision on this policy, we need to make sure that's in there.
Yeah.
So if you ever happen to be reading something like, why is that in my insurance?
It's because it saved them money on a payout of a lawsuit.
Left-handed people named Sally. Why is that? It's the left-handed Sally exclusion.
Right.
You know, if you have a loss with a left-handed person named Sally, not covered.
So on the covered cause of loss, basic is basically what you don't want. You don't get the basic. Don't allow somebody to get basic who is one of your buyers, because again, you know, at its core, when we're talking about doing seller financing to a buyer, we need them to be covered. Our job, we can't tell them legally who they can and can't get insurance from. I want to be very clear on that, but we can approve and disapprove a policy. So we need to have standards, and you need to write these standards down and have them filed away someplace so that nobody can cause a discrimination suit against you or something. Have a policy of what you will and will not accept in your policies that one of your borrowers are getting, and basic should not be in that. You should have at least, not special, but what's the one? Broad. At least broad,
and
right?
Really, here's the thing. For most of your listeners, your subscribers, I would hope that the properties they're putting out, unless you're like Steve Blasco and you love the slums, you love the rundown bad part of town, unless that's your thing, then I would hope that you have a nicer, renovated, reasonably nice home, and nice is such a general word. I hope you don't have something that is not renovated, that is, you know, galvanized aluminum pipe or something that makes it to where you can't get special. Requiring special form cause of loss is not unreasonable in my opinion, because if you got, even if the house was originally built 80 years ago, if you fully renovated it in the last 30 years, then there's no reason why it shouldn't be able to get special form cause of loss. Because the difference between broad and special, or especially from basic to special, is things like frozen pipes, falling objects, collapse of the structure, full featured water damage. You got vandalism and malicious mischief. You got theft endorsements. There's a lot of difference between what could be a very basic policy, no pun intended, with basic form cause of loss versus special. And the difference is, if something's not covered, then your buyer is coming out of pocket for that, which increases the likelihood that they won't be able to pay their note, which increases the likelihood that you have to foreclose. So requiring special form cause of loss, requiring a minimum of functional replacement value. If I'm the one writing that note, I'm putting there the insurance requirements. You got to have special form. You can't have more than a 2% roof deductible, and you can't have less coverage than FRV. You can't have ACV. We're not going to let you.
Right. Yeah, we don't allow ACV either. So let's talk about coverage of coverage amount a little bit, right? Because that's a common question. Now, my requirement is that their coverage amount for total loss is a minimum of whatever their loan is to me. Is that something that you would accept as being? Obviously we want to give them more, but I guess give us the reasoning why we might choose to, or they might choose to have a little bit larger coverage. Because I know most of the time when you get an insurance quote, they want to quote you for like 150% or 120% or something like that of the value of the home. Tell us a little bit about that.
And here's really where it gets a little bit sticky, because there's three values that we have on a property. There's obviously the appraised value, and everybody loves to protest appraised values because they range dramatically depending on where you are and what the appraiser had for breakfast, right? So appraised value is one. Then market value is the second one. That's what you can sell the house for. What is someone willing to pay you for it? I don't care about either one of those. That means nothing in my world. I don't care what the loan amount is. I don't care what the appraised value is. I don't care what the market says, because I'm not a real estate agent and I'm not your tax assessor. I'm your risk manager, which means the only one I care about is replacement value. If this thing burns, what is it going to cost you reasonably with materials and labor and market conditions. What is it going to cost you to rebuild this thing to its current condition and kind? Is it a 1,600 square foot frame house with hardy plank and a 3-tab roof with builder grade finishes? Okay, great. Then I want to rebuild you, if the whole daggum thing burns, a 1,600 square foot house with frame and hardy plank, a 3-tab roof, and builder grade finishes.
And that's the number that you will see policies say 120% of is the replacement?
I wish it were that. Unfortunately, and I'm not going to name anybody, but the average insurance person just doesn't care enough to do simple math.
Gotcha.
They put it into their system, and whatever the system says, they just run with it. They might check to see before they get their hand slapped by the mortgage person and says, you haven't even covered the loan amount.
Yeah.
Like, if they're a little proactive, they'll make sure they know what the loan amount is before they run their quote, and 8 times out of 10, they're going to match the loan amount, send you a quote, and call it a day. You've probably seen that. You've probably seen that. That is not serving your needs. That is not delivering solutions that are for your unique situation. And that goes into what we're going to talk about here in a little bit, is vetting your agent. When it comes to coverage amount, it really depends on kind and condition. It depends on how old the property is. I personally use $120 a square foot as my starting point. And then if it's a really nice house, I'll go north of there. If it's got finishes that are better than standard, which we all know what standard is, it's like a gut thing.
Yeah.
You know it when you see it. If it's slummed out, if it's in poor condition, if it's older, I'm going to be decreasing off of 120 a square foot. The lowest I will ever go is 90 a square foot. I don't care if it's a junker in a bad part of town and it's 60 years old. I'm not going less than 90 because we all know at a certain point diminishing returns kicks in, and you're just not going to get any less than, you know, in my opinion, it's about 90 for material, for labor, for market conditions. Yeah, you can really skimp on the construction of a house, but if you're going less than 90 a square foot, I don't know if you can really rebuild the house the way that it should be rebuilt. Yeah. So when it comes to value, just think of it as a range. Usually 120 a square foot, if it's your standard rental, if it's your standard seller finance property, you know, built in 85, 1,800 square feet, replacement value probably somewhere around 150, 170,000. These are obviously very general numbers for our market. Your market, if you're in California, it's like
that
8
might be a
times
trailer.
that much.
But the minimum requirement as a lender, your minimum requirement should be your loan amount.
Absolutely.
Absolutely, positively. If your borrower is coming in with insurance, the minimum coverage amount needs to be whatever they owe you on that wrap. Total owed, right? Like if they owe you, if you know, did a sub 2 assignment and then a second lien to them and both add up to 150, but your lien is only 20. Well, don't get it insured for 20, get it insured for 150. Whatever's going to pay off all of the mortgagees, that's the minimum requirement for this type of thing. Okay, so vetting your agent, right? That's going to be, you know, I know one of my students, unfortunately, went with somebody who I haven't used before and was not necessarily my recommendation for insurance. And they got a note called because this person was calling the bank and kind of screwing things up with who the mortgagees were and that kind of stuff. Vetting your agent is big. What do you have to say about vetting your agent whenever you're looking at doing this kind of stuff? Creative financing.
I'll be totally real with you. If we would have had this conversation 3 years ago, I wouldn't have known the right things to do. And it's taken a long time to get to the point where I'm at right now, where I can answer pretty much any question you have in this. 3 years ago, I would not have been qualified to do the insurance on an owner finance
Very few insurance people are.
Yeah, and the reality is, I mean, if you sit them down and don't give them access to Google and ask them very basic questions about owner finance, or especially sub 2 or wraps. When we get into more creative wraps, where you got wraps on top of wraps, and then for one thing, never go more than 2 lien holders. If there's a third lien, who wants to be third lien? Like that is like that's the toilet paper at the bottom.
Hey man, I'll tell you some ways you can make third liens make you some money. But it does get...
From a risk management perspective, third lien is a really sticky place to be.
I have a slot in my master spreadsheet for 3 liens because we have 3 liens on things and we make good money on them. One reason might be you do the wrap, which is technically a second lien, but you can actually do that wrap as like an 80-20, right? Okay. And then sell the 80 and keep the 20.
You see, I shouldn't talk about third liens because I don't know this stuff like this guy does. Insurance and risk management, I can talk about and not get myself in trouble.
There you go. Okay,
so when it comes to vetting, really these next two really go together.
They go very hand in hand. They really do.
Parties and making sure that everybody's in the right seats on the bus.
Let's start drawing this out, what the right seats are, because this is my advice for whenever you're vetting your insurance agent, is ask them. Because here's what's going to happen. Your conversation with the new insurance agent, you're going to be at because insurance people are salespeople.
Yeah.
You're going to be at a networking event and you're going to be like, hey, I do a lot of owner financing. Can you do that? Oh, yeah, sure, we can do that. Can you do wraparounds? Totally. Have you done wraparounds? Well, our office has done wraparounds. Okay, who does wraparound? Well, I know this guy that's done wraparounds. Okay, that's what always happens. Here's the conversation that you need to have. If you say, can you do wraparound mortgages? Sure, I can do wraparound mortgages. Here's the first question I ask, which I don't even know the answers to these, but I want to see that they know the answer to it. Who is your underwriter that does wraps? Okay. I don't know the names of y'all's underwriters, but I need to see that this person can regurgitate, oh, that comes from so-and-so, so-and-so. They're the ones that do my wraps, because not every insurance underwriter will underwrite a wraparound insurance policy.
Here's the thing. Most of the underwriters, because when I started doing this a lot more, I went out and called all these carriers. I called the underwriters. I called their product team. Was like, hey, do you guys do owner finance properties? They're like, owner finance properties? What's that?
Yeah.
Like, I don't know. I'm going to have to ask my supervisor.
Right, totally.
It's like, because if the underwriter is like, it's not going to
happen.
No, and here's the reality. Most insurance companies really don't like.
They don't.
Owner finance. They really don't like subject to.
Which is why you've got to vet your insurance agent and ask them these kinds of questions. Because if they can pop up and say, oh yeah, we get that done through, whatever, Pacific Northwest.
And I never want to throw specific companies under the bus. The only thing that I can say, when it comes to seller finance, especially sub 2, in the last 2 months, I have had 3 different agents from one company that rhymes with moose bed. 3 different agents. All 3 of them wrote a sub 2 policy completely wrong.
Incorrectly.
Got it canceled post binding, and it was a 30-day cancel. It wasn't we're going to wait for your renewal.
Yeah.
It's we don't like this. You wrote it incorrectly, and we're going to cancel it right now. You got 30 days to find something else, and that happened 3 times in a row. It happens because people write checks they can't cash.
Right.
What I would say, and I'm going to draw it for you right now, if you're at a networking thing, if you're at the Propelio Live event, they're going to have them all throughout the summer. Find yourself a napkin and say, hey, would you just draw for me? Draw me the tree real quick.
Yeah.
And show me the positions on an owner finance property.
That's really the biggest thing you can do to qualify. So it's kind of I like to ask them who their underwriter is, because, like Foremost has done a lot of our wrap stuff. And so if they say Foremost, it's like, okay, well, I know they're in it and they're dealing with it.
Yeah.
But the real one is, can you tell me the interested party? So that's what we're going to draw out right here.
Yep.
So show me what are our interested parties that need to be on a subject to wraparound mortgage.
Yeah.
Okay. Let's use Joe and Betty as our seller.
Okay.
Okay. That's the person that we're buying sub 2 from. Let's use whatever, LLC, whatever. Investor LLC, or what do we want to call our
one LLC?
That's going to be your LLC that you're buying the property sub-2ing and wrapping from.
Yeah.
And then let's say Wells Fargo holds the bank note, and Jose and Bettina
Bonita. There you go. Because she is muy bonita.
She's got it going on.
Oh yeah.
Okay,
so here we go. This is a traditional sub 2. It's nothing fancy. You got to remember, this is incredibly important, and I don't care that we're going over a little bit. We'll get to the point. The primary named insured, first named insured, is the one that calls the shots on the policy. They are the one that gets the check from the insurance company after the mortgagee is satisfied. In a sub 2, there's 2 mortgagees. So the first named insured is going to get the check from the insurance company after the first and second mortgagee is satisfied. The sticky thing where you really need to make sure you have all of your ducks in a row is power of attorney for insurance checks to get cut to, in this case, Jose and Bonita. sorry, Joe and Betty are the seller. Jose
Yeah.
and Benita are the buyer. So Joe and Betty are going to get a check from the mortgage company on the underlying note. When the mortgage company gets happy that they are satisfied, they're going to cut the check to Joe and Betty. You need to have your ducks in a row to make sure that Joe and Betty just hand you that check and call it a day.
And once we talk about these parties, I'll give you guys the best practice on how to handle a claim check that comes through. Because what's going to happen is going to be one check that's going to have 1, 2, 3, 4, 5, 6 names on it.
Yep.
How do you get that cashed?
Yeah.
So I'll walk you through how to handle that best practice too.
So I'm going to say this is first named insured. That is going to be Jose and Benita, your end buyer. They are the one that buys the policy. All you get to do is sign off on it. And really what you need to do is just say hashtag better call James and let James take care of it. And then you sign off on it and everybody's happy. But you can't tell them to do business with me. You can just suggest it.
Right.
So we've got Jose and, come on. Are we, pen? There we go. Jose and Bonita are first named insured. And then first mortgagee is going to be Wells, because they are the underlying lien. They are the mortgage company that Joe and Betty had way back in the day.
So think of it like first lien, first mortgagee.
Lien holder. First lien, first mortgagee.
Yeah.
Lost payee.
Right.
All the same thing.
They'll be called, commonly it'll show up on the policy as a primary mortgagee there. So you might see first mortgagee, primary mortgagee. Is there another language that they might use on that?
Lien holder.
Lien holder.
Primary lien
Primary
holder.
lien holder.
Lien holder. Yeah. So I'm going to do one lien holder for first lien holder, and then 2 lien holder. That is going to be your LLC. So you only get paid after Wells is happy that they got what they need to have, and then they are releasing that check to their the person that's on their mortgage. So Joe and Betty are going to get the check from Wells. The only way you ever get paid is if you do what Grant tells you to do here in a second. Now, here's where I go one step further to protect you from a liability incident, and also to make sure that it's less likely that your underlying lien gets called. You're going to have 2 additional insured slots that you're going to fill. The first one is you are going to add your LLC not just as lien holder, but also as an additional insured, because in the event that there is a liability incident at that subject property, you're going to be named in a lawsuit. I can pretty much guarantee you, because any lawyer worth half a pile of dog crap is going to do some research and find everybody attached to that property in any way, and they're going to sue each and every one of those parties. So when you add yourself as an additional insured, it's just lawsuit protection. That's all it is. There's really no benefit beyond that. You're making sure that in the event of an accident, an injury, third-party liability in some way, that you're not tied up in someone else's problem. And the last thing is you're going to put Joe and Betty as additional insureds on the policy as well. This is not mandatory. A lot of people don't do this step. This makes it less likely that the underlying note ever gets called, because at the end of the day, if someone even looks at it, as long as they see Joe and Betty's name on the insurance policy, they probably don't care beyond that.
And I'll tell you from experience too, if you submit this insurance policy and it does not have your seller's name as an additional insured on there, it will probably be rejected from the bank, and may cause the due on sale clause to get called on that. So always, my suggestion is always put the seller's name as the additional insured on there. So here's what we're going to run into. What we're going to run into is we've got a check. Let's say that we've got a total loss, okay? So total loss, or not even a total loss. Let's say a roof damage. You're going to get a check in the mail, and that check, or actually Jose and Bonita are going to get a check in the mail, and that check is going to be written to Jose, Bonita, Joe, Betty, your LLC, and Wells Fargo. All of those names are going to be to pay to the order of line. So here's what you need to do. And this is not the only way to do it. This is my best practice. This is the way that I have found through our experience to be the easiest way of going about getting this insurance paid. Before anybody touches it, take that check and mail it to the primary mortgagee's insurance department for them to endorse and mail back, okay? Every bank has their own kind of cap where they say, if the claim is for under $10,000, we're not even gonna worry about it, we'll just sign the check and send it back to them. If it's over $10,000, we're gonna hold the check and disperse the payments to the contractors as is necessary, okay? But I've never had to deal with that. I've only had to deal with claims that come in where they're just like, yeah, we'll endorse it and send it back. So before anybody signs it, because they will not endorse it if somebody else has touched it, mail it to the insurance department, they will endorse it and they will send it back. At that point in time, you need to take Joe and Betty and you need to go to your community bank that you bank with for your company. That is not Chase, that is not Wells Fargo, that is not Bank of America, it is a community bank because you need to be banking at a bank where people know who you are, specifically for things like this. You need to take your power of attorney that you had signed with Joe and Betty whenever you bought the house subject to. You need to take your buyers, Jose and Bonita, with you to your community bank, and they need to have their IDs, and you need to go to your teller and you need to say, I need to deposit this check, okay? And so Jose and Bonita are going to sign in front of your teller with their ID. They're going to endorse it. You are going to use your powers of attorney for Joe and Betty to endorse it as Joe and Betty. Then you are going to endorse it for yourself as your LLC and deposit it into your account. And when that check has cleared your account, you can either disperse directly to Jose and Bonita to get the work done, or you can hold those funds and check on the rehab and disperse funds directly to the contractors as necessary. There are other ways to go about doing it. Insurance is a pain in the butt. That's been the way that we have found to be the most reliable in getting these things taken care of.
Yeah.
All right.
Yeah, that's a good talk.
It is. Thank you so much for taking the time out. You know, James is a busy guy. He's got to head out and get to another meeting. He's got some really important stuff going on this afternoon, but I thank you for taking the time to go over that stuff with us.
Yeah.
I've made James an honorary member of CreativeCashFlow.com, so if you guys are on the Facebook group at CCF Mentors, you can tag him. He's out there paying attention to you guys. If you're not on the Facebook group, you need to join the Facebook group. It's at CCF Mentors. Any member of our CreativeCashFlow.com Academy gets to become a member of that Facebook group. So please take advantage of that. That's a great way for you guys to build each other up and work together. So James, thank you so much for being out here.
All right.
I appreciate your time.
Appreciate it. We'll see you guys out there in the interwebs.